Hello and welcome to Advanced Bookkeeping Practice Assessments. Today we're going to do the Osborne Practice Assessment number 1. So what are we going to see today? Well, you're going to see a practice assessment undertaken in real time. And what this will do is it will show you the exam technique that should be applied. In particular, the workings that you should have going alongside each of the questions. Typically about 10 pages worth of workings. So if you're not undertaking that amount of workings in there and you're not getting that amount of paper, you should be thinking about that really. I'm going to apply a particular method which will make sure that you will pass. Now, it's almost like taking money into the exams. If you're not applying this method, you're making life a lot harder for yourself. So you'll see all the workings that should be associated with the questions. So not just the answer, but what your working paper should look like. You're going to see, why do I take this approach? In particular, you'll see a heavy amount of paper workings alongside it. Well, your exam is a computer-based exam. It does lack a bit of accessibility in terms of you having to scroll up and down. And so if you're trying to sort of answer the question rather than applying technique and dropping the things into the right boxes, it's going to be a lot of mental arithmetic and thinking going on. Now, that's not going to work, really. Also, as well, you won't have a method which is going to check whether you got this right or wrong. So the technique that I'm going to apply and that you'll see will actually sort of highlight whether your workings are correct and your answers are correct in the exam. So that will be a lot better. If you're being asked by your tutor, check your work. If you're simply redoing the question, you're not really checking your work. All you're doing is redoing the question with a different answer. This will actually check your work and correct your errors. And because of that, because it's just we're actually doing things that are going along and it's checking the work, it's going to be really counter the stress. It's going to be a lot less stressful, this approach that we're going to take. In terms of time, I sort of say it might take a bit longer when you're doing this first time in terms of your first approach at the questions, but it's 100% correct first time, and therefore you don't have to go back and redo the questions. So it's more effective time-wise there. But you know, you'll see the length of time that I take my time with this thing there, so probably could do it a lot quicker, but I take my time with the actual answers. And as you'll know if you've watched my videos, I apply this very much of a technique-based method to accountancy. We undertake a technique for each question and the answer drops out. So this is where you're effectively taking myself into the exam with you, and we just start to apply the technique that I'm laying out, and the answer drops out. You don't really have to think, and that's quite useful. It's always more accurate because accountancy is about technique there, and it's a lot less stressful. As I say, you're effectively taking me into the exam. So what are we going to see today in terms of the questions? Well, we're going to see I'm going to call them fixed assets. That's what this industry calls them. They're called non-current assets questions in your papers, but what they are really in reality is fixed assets, things that are fixed, things like computers and land and buildings and cars and office equipment, that kind of thing. They're fixed over time in the business, not within a particular year. And so we'll see a fixed asset register, a non-current asset register question. We're going to have a disposal of an item, of an asset, and we're going to have some depreciation calculations, straight line and diminishing balance. Also, another term for diminishing balance would be reducing balance. We're going to have prepaid and accrued income, and we're going to have prepayments and accruals. Yeah, so we'll have that. We'll apply some timelines for that. You'll see how to make that very easy. We'll have some timelines along with T accounts. We're going to have some trial balances and extended trial balances, and we're going to have a reconciliation question. In this instance, it's going to be a purchase ledger, purchase control account to purchase ledger reconciliation. Sometimes you'll have a bank reconciliation as well. And so if you're struggling with those ones, watch this video and you'll have that answer there. Also as well, that you can go into the level 2 bookkeeping controls one and I lay out how to do the reconciliations there. We've got an errors and suspense account question going on as well, and then we've got a lengthy extended trial balance. So hopefully you'll enjoy that and good luck with it. Task 1. This task is about recording information for non-current assets. So non-current assets, better word for it really, fixed assets. In this case actually fixed tangible assets, so assets that you can touch really there though. So these are fixed tangible assets, which are things that go basically used by the business past more than one year. So things like computers and office furniture, land and buildings, cars, things like that. So that's what we're expecting to see here. Known as blending builders, registered for VAT. So we got some VAT going on. And here I'm going to put my notes. What I'm going to do on the right hand side here is this is what my piece of paper would look like really. Registered for VAT, financial year the 31st of March. So let's go April. Let's put a nice little timeline in just in case we have some kind of monthly depreciation going on. March. And okay, right. So we got an invoice. We've got a purchase invoice in here relating to a printer to be used in the office. Right. What we're gonna see here is we're gonna probably see some invoice in here with an amount. We're gonna have some kind of delivery thing, something to put into place, which will add on to the amount. And then some silly little thing which was actually a consumable, which isn't going to go into the cost. And let's see where we go. All right. Okay. Oh look, there we go. So there's the amount. There's the printer. And so that's going to be, and when are we going to buy this? We buy it on the 21st of March. So it's going to be here, 7.55, and there we go. There's the delivery charge coming in there. Okay, so it'll be 7.55 plus the delivery charge of 25. Oh look, and there's the printer cartridges there, which don't go into the cost. That's the consumables. That's the cost in the year. We got VAT over here. So we're going to go net, and we're going to have the VAT in here. It's going to be 20%. Times by 0.2, and total. We paid the invoice in full in the 30th of March. It doesn't say how we paid it. So let's just sort. Well, so we'll have some kind of a bank there. So what we're going to do then here is we're going to go debit printers, or whatever we're going to call it. And though this amount, this 78.80, we're reclaiming the VAT back, and we'll go credit the bank. And we're also going to have debit the VAT. So the VAT would be that one there, and we're crediting the bank those two, just for when we have some kind of journal we're going to put in later on. Right, so that's what we've done in the first bit. Let's see where we're going. What I would say is I put my answers as I'm going along, just as I'm writing, so it's very much of a technique. The following information relates to the sale of a car. So we've got some kind of disposal going on here. We've got a registration number here, so that's probably going to be some kind of fixed asset register. Now I've got a date of sale, I've got a selling price. And there, okay. We capitalised the expenditure over £500. So we've got a capitalisation thing over here. £500, right? So this one goes over £500, so that would be capitalised. Vehicles are depreciated at 25% minimum reducing balance. Alright, so a computer equipment is depreciated on 20% straight line balance, assuming no residual value. So, why is it saying assuming no residual value? We would normally go cost minus residual value. So that in brackets, okay, times by the rate is depreciation on a straight line calculation. Okay, let's go equals, and then equals, and then depreciation. So that's the calculation for straight line. So we've got no residual value. Okay, a full year's depreciation is applied in the year of acquisition, not in the year of disposal. That's important there, though. Sometimes we'll see it as being monthly, and sometimes we'll see it like that. Okay, complete the extract from the non-current asset register, so the fixed asset register, on the next page 4. And why do I keep saying fixed assets, by the way, is because that's what the term is that's used in real life, in practice. If you were talking about non-current asset register, people would go, what are you on about? So complete the extract for the fixed asset register on the next page for any acquisitions for fixed assets during the year 31st of March 2000, and any disposals, depreciation for the year ended. Okay. Show my answers to 2 decimal places. Right. Let's go over the page then. And here's our fixed asset register in here. So we got our computer equipment, and we sold the car, didn't we? So let's just now got some shapes that we're going to introduce in here. So we have nothing here in terms of this equipment wasn't disposed of. It continues, so we're going to have a depreciation charge of 192 in there, and we're going to have our carrying value going forward. Get the calculator out. That's going to be 384. Okay, so that's the first bit. Now then, so I assume that we've got to put in here, this is going to be where we're going to see this new one. We haven't got a little drop down box in here, but we're going to see, because we've got a little gap above it, we're going to go, which will be this purchase that we made. So that is the QX printer. Okay, let's just check what we're supposed to call it. It will be the QX laser printer. And it would be nice if they were done properly, because in a fixed asset register you would also have location somewhere, so you can go and find it and check it. Right, but that's missing from here. Acquisition date, so we're going to put the acquisition date in, which was 22nd of March. Three XO. Okay, so that was that one there. Oh, we're going to put in there. Now the cost, remember we put it over here, it was that figure there. We didn't include it. You don't add the VAT on because you can recover it. If you couldn't recover the VAT, you'd add it on because it would be the cost, the item there though. It included the delivery charge to get in place, but it didn't include these printer charges here. So 780 is the amount that would be going into that one. So let's insert another shape in here. And the cost then is going to be 780. Our depreciation charges then. So it says that we are computing at 20% straight line. So depreciation charge will be 20% of that on a straight line basis. We've got no residual value, so it's 156 for that one. Insert. Goes into that line there, which is in a particular year. And our carrying amount then will be the 780 minus the 156, which is 624. Okay. Funding method. We bought this for cash. Said we fully paid it, didn't we? So there wasn't any kind of finance lease or hire purchase or whatever. We've not disposed of it and what have you. We got this vehicle in here. So we're just going to, we've got, now which was the one that we sold? We sold the registration plate LN07SBT. LN07, so we sold this one, so we've disposed of this one. We've got no depreciation then in that year, so we've no depreciation in the year of disposal. And remember in this one we had a full year's depreciation charge in the year of purchase, even though it was purchased in the last month. So that's going to go down to 0. And the carrying amount is going to go down to 0. There. We've got our disposal proceeds. This one, which we're going to put into here. What did we sell it for? 11,500. So 500. And the disposal date was 15th of March. So this is quite, as long as you know what you're doing, you just keep your head together. This is quite a nice question because we're just filling in a few boxes really, aren't we? 03 0. Okay, and then we've got this last one in here, which is just going to be another year's worth of depreciation for this item here. So we've already depreciated it 4900 in the previous year. Oh, actually, no, hang on a second. Oh, let's just slow down a second here, partner. Let's have a look at that one. Note, vehicles depreciated at 25% on diminishing balance. So that's what we're being lured into here. That was straight line, so you'll always have the exact same amount of depreciation each year. This one's reducing balance, so it would be the value of the previous year, 14,700, and we're going to what was the rate, and it's 25%. So 25% of that times 0.25. So that is the amount there. 675, and the value at the end of the year is 11025. Right. Hit the wrong button there. $11,025, and that is our balance, or our fixed asset register sorted out. So complete the extract from the fixed asset register, the non-current asset register on the next page for those there. Right. Anything else in this question? No, that seems to be that question done. Task 2. So this task is about ledger accounts. So we're in the general ledger for non-current assets or fixed assets. So we're in the general ledger, so we're going to start setting up some T accounts, let's say, before we start. Get these all done. So we've got some T accounts going on here. What am I doing here then? So, okay, working the accounts for business is registered for VAT. So we've got VAT going on. During the year, an old vehicle, a van, so we got a van, and here was disposed of. Right, okay, so we got van at cost, and we're going to have some disposal. Now I'm going to call this profit and loss, profit stroke loss on disposal, because that's going to remind me that the balancing figure is going to be the transfer to the profit and loss account. And you might find that easier if you do it like that. Vehicle had been bought for £10,000. The VAT was reclaimed. So we've got a VAT account in here, but we'll leave that. The VAT was reclaimed some years ago. So £10,000 vehicle cost, we went debit that. 2 years of depreciation has been applied. So cumulative depreciation. We've got 2 years worth of that going in there. Depreciation is at 30% on a diminishing balance basis. So diminishing balance. So in the first year it would be £10,000 times by 30%. And the second year this asset is worth 7,000. The 10,000 minus 3,000, and that's going to be then times by the 30%. So that's going to be our depreciation in the second year. On depreciation balance, the vehicle was sold for 5,200 plus VAT, with a payment being received into the bank account. So we've got a bank account in here, and we would have had disposals here, which would be 5,200, and we've got debit there, and so we've got credit bank over here, 5,200, and then we've also got debit the bank with the VAT on that. So we've received that from the person we sold to, and so we're going to have that credit sitting there. So that's our double entry bookkeeping for that part of the sale. And now we're going to finish off our disposals then, as I'm assuming we're going to have that. So we will be crediting the van at cost and debiting the disposal account. And we're going to debit the cumulative depreciation 5,100. And we're going to credit the disposal account. And you'll see that we'll have a difference here. So this one's higher than that one, so we got more basically in than the value of the business, the amount. So we're going to transfer to the profit and loss account. Well, we'll leave it as profit and loss and disposal, which is going to be profit and loss account. Say whatever we're going to have, we'll see there. This is going to be the difference between those two, plus that minus that there. Okay, so that's our profit. So that's what the T accounts will look like. Let's now go and answer the question, see what happens here. And I do this like this because it's easier to have my workings as I'm going along and reading down, and so it's more effective on when we're doing an electronic exam. So let's go through and see what's happening rather than flicking backwards and forwards as we're going on. So calculate the cumulative depreciation. So we got that. We've got that one. That was 3,000 the first year. And then we're going 2,100 in the second year, and our total was 5,100. That's answer A. That's quite easy, wasn't it? Right, now we've got some our T accounts. Let me just put this in here so you can just. It would be nice if we had some kind of. I do wish that they would create these a little bit more. Have a nice big thick there though, and it's black, and let's give the weight a bit more, make it nice and thick like that. If we put that there, there's our nice T account there. So really what we're going to do is we're going to take our T accounts over here, and we're going to drop them in. So here's our balance brought down in here. So we're now going to have our disposals. Now let's see what we've got available to ourselves. We've got our disposals, yep, we have. So disposals would be here. Now what happens as well is what they will do in the thing to just test your technique is they're only going to give you, let's say we've got 5 here, That'll give us 3 of them or so, probably, to just see what we're going to do. And then we're going to, there's no balance carried down in there, so we're just going to total. Actually, we can just, we can now just copy these down in here. So let's just copy this, and one would go there, and another would go there. So that would be our first one. Okay. And let's go into what else was the next account there. No, for vehicle disposals. So we've got all these items over here. So we're going to be bringing up the let's see what we've got available to ourselves as a descriptor for the debit associated with that. It's going to be something like a cumulative or something. Vehicles at cost. There we go. Vehicles at cost. Cost. And that's going to be that 10,000 that we got over there. So let's just copy that and drop it in. Okay. Now we've also got the accumulative depreciation. So shapes. What we've got available to ourselves over here. Vehicles accumulative depreciation. I'm just good for. There we go. That'll be the accumulative depreciation, and that would be that 5,200 there. Okay, so 5,100 there. Okay, we've now also as well got this bank figure in here. So then we've got a bank available to us. We've got a bank. There we go. That's quite nice. Insert our shape. We've got our bank in here. That there, and that one is going to be 5,200. It's not going to go into this thing, which is a bit annoying, isn't it? Well, let's just take that one out and redo it again. Okay, 5,200 to there, and we need to have what we're going for: statement of profit and loss. So that's we're going to try and find the one that's equivalent to profit. The statement of profit and loss account, something like that. Statement of financial position, could be anything in there. So we found that one. So that one's going to be our statement of profit and loss. Statement of profit and loss. Okay, and we'll put that 300 into there, and then we would close these down with the 10,300, and I'm going to just skip on to save some time. So 10,300 will go in there, and 10,300 will go in there. We've already transferred that over, so there's no carry down or brought down or anything. Oh, and we've got a bank account one here. So you notice there we go. We got 3 here. Really, we had 5 going on. So what it's done is it's trying to sort of say, go on, have a go. Just do 3 of them in there though, on the thing there though, with some scrappy piece of paper. Don't do the whole lot. Make it all nice and easy for yourselves in here. Takes all the stress and pressure out. So we've got our bank one in here. I'll copy this across. What we're going to have over here. So we've got our disposals. Oh, and we're going to put the other one in there as well for our VAT. If I can get my fingers working. Into our VAT. Okay. VAT 1040 in here, and over on this side is going to be the balance carry down. Let's just check that was our option. What we're supposed to call it? Balance carry down. Okay. Balance. There's a little slash that we're going to there, and that would be 6,400. Also 6240 there. Those figures there. Then we put 6240 here and 6240 there. So that's our thing there. So the real trick here was it sort of give you 3 of the T accounts that were relevant in there, but you would put really you would do all 5 to just make sure that your double entry bookkeeping was solid. Right, tick the relevant box to show there's a gain or disposal on the vehicle. And so here what we could see is that the value of the asset was the value of the asset was 4,900. So we had a cost was there, it was 10,000. The cumulative depreciation was 5,100. So it was 4,900 is the value of it. We sold it for 5,200. So we sold an asset for 5,200 that was actually only worth 4,900. We made a profit. So that's a gain. So we got a gain there. And really, if you sort of think about it here, here's our profit and disposal. So we had to go debit profit and loss and disposal, credit the profit and loss account. And so it was credit, the profit and loss account, increase in the liabilities of shareholders, which is profits is gain. So that was that one. Right, the owner of the business is concerned that the carrying amount of one of the other vehicles is lower than it could be sold for. Okay, we're going to have some kind of trick here, which is going to sort of say we should accelerate depreciation. She asked if the depreciation rate should be charged so that the carrying amount is equal to the market value. All right, there we go. We've got some accelerated depreciation. Which of the following answers to give her? Right, so basically, depreciation is the accruals concept, and what it does is, and it's what's known as historical cost accounting. So what we do here is we're sort of taking the cost of our item and we're sharing it out over the years. It doesn't actually really matter whether the value of the asset is worth less, unless we're going to sort of sell it. And there, stock would be different if we're sort of in a situation with, let's say, stock, and the residual value of the stock was less than what we purchased it for. Then we would be making an adjustment because we would already made losses. We would recognise those losses up front. But this is not associated with recognising losses. This is just the value of the asset's worth less than the carrying value. So here, yes, because depreciation must reflect the market value of the vehicle. Specifically, no. The market value of the vehicle is not represented within the accounts under historical cost accounting. Yes, because the reduced rate depreciation will improve the profitability of the business. Well, in future years it would do, but that is just simply manipulation of the accounts, so that would be unethical. So no to that one. No, because the depreciation rate cannot be changed during the life of a vehicle. Yes, it can. We could decide, we could work out that the depreciation rate was wrong. That actually it lasts longer, or the useful economic life might be different. Whatever, we can certainly change the depreciation rate during the life of a vehicle. No, because the purpose of depreciation is to spread the estimate of the loss in value of the vehicle over its useful life. So that is the purpose. That is the point of depreciation. So it is D. So the answer in here is D. Go. Okay. So that's task 2. Task 3. This task is about accounting for accruals and repayments of income and expenses. Okay, so we're going to have some timelines going on here. You're working on accounts records for a business ended 31st of March 2001. So we're starting off in April, X0 because we're crossing years. Drag this out to March like that. Next one there. Okay. No VAT. Right, so we can ignore VAT, so there's no VAT. Yeah, the following information. The balance on the rent receivable account, so let's get some T accounts set up as well as we're going through. Then we can do the double entry bookkeeping because we're reading this rather than trying to read through and then answer the questions at the end and effectively double up on what we're doing. Plus, it just takes a bit of stress out of the whole thing. Right, balance on the rent receivable account at the beginning of the financial year, 650. Okay, so at the start of the year, this represents a prepayment for rent receivable as at the 31st of March 2012. So we've got a bank account here, and we've got a rent receivable. And we've got some kind of deferred income. So what happened here is we got a payment here. We were paid this £650 here. There. And this actually related to here, so it related to this point here. So at that point we went debit 650. So in this point here we had debit 650. It shouldn't have gone into the rent receivable amount because it's relating to this year here. So instead we went credit this deferred income in here, and either deferred income would be prepaid income, or see what it wants to be called. Deferred income is the term that people mainly use, but we seem to be saying prepaid income before we're going in here. So so that's what we're opening up with, is this figure here. Then what we'll see is on the first of the following month, and on the first of the following period here, so first of the fourth, sorry, x0, we will reverse this out. So we'll go debit this deferred income here, or prepaid income, whatever it's decided to call it later on, and we're going to credit the rent receivable account because that is when we now have received it. Okay. And the cash book for the year shows rent receivable. Sorry, rent receivable of 8,000. So we got 8,000 here, and that's come from the bank account there. Right. The rent receivable account has correctly been adjusted for 2,100 for the quarter ended 31st of March 2001. Okay. This was received into the bank and entered in the cash book on the 31st of March. So 31st of May 2001. It was received into the bank and entered in the cash book on the 29th of March. So here we received 2,100, and it's in that. So in that and that we got 2,100, but it actually relates to March, April, May. So for 3 months, because of the quarter, there's a quarter. So really, it's 700 for there, 700 for there, and 700 for there. Okay. Those two are outside of our year, and this is in our year. In here. Right. So we should then have an adjustment, which would be to credit the deferred income for the bit in red that's outside our year, rent, and debit the rent receivable account, because that 8,000 isn't all for this year. 1,400 of it is for next year. Okay, so that's what we would have there. Anything else? Nope. Right, let's start answering some questions then. Complete the following statements by calculating and selecting one of the options. So on the 1st of April, the rent receivable account shows A. So on the 1st of April, here. So let's delete out these here. On the 1st of April, this is how the our general ledger would look. So we went debit deferred income 650, credit rent receivable 650. So let's goes back in there. So it's going to be a credit of 650. Oh, somewhere along the lines we decided to wipe out our figures. So let's just put those back in there. Credit the deferred income 140 and debit that rent receivable 140. Okay. So it will be credit, and it will be 650. On the 31st of March 2001, the rent receivable account shows an adjustment for. So what did we adjust for? We adjusted for this 1,400 in here, which will be rent. Yeah, an adjustment for. And now what are the options in here? I've put it down as deferred income, but we've also got prepaid income, haven't we? Accrued expenses, no. Accrued income. Accrued income will be the other way around. This would be that we received the invoice over here in May, or we received the payment in May. And it was actually relating back to these periods here. So that's not the position, that's not what happened. So it's not accrued income, which is the opposite. It's not a prepaid expense, so it'd be prepaid income. So it's going to be prepaid income. It's going to be this one. Okay, so prepaid income of, and it was 1,400. I'm not liking the term, as typically it would be called deferred income, but that's where we are. So we're going to go prepaid income then. It could also be called, if you might have an option of deferred income at some point in there, 1,400. Calculate the rent receivable for the 31st of March 2001. So what we're going to do here is we're going to close down our account and transfer it to the profit and loss account. So the P&L account in here, which is going to be equal to that plus that minus that. And that's what we're going to transfer to our account, which was 7250. Okay, so that was a nice question. No real thought going through there. What else have we got now? Page number 2. Right, the cash book for the year shows payment for vehicle expenses of right, so we're on to a different one now here. So let's have some T accounts. Also, we're still on the thing, aren't we? So let's have our nice. Let's hold on to our timelines. Yeah. Cash book for the year showed for vehicle expenses, so let's put some T accounts in as well. So let's make this a bit easier, and let's just copy our T accounts over from here. Okay. Cash book for the issue of payments for vehicle expenses. So vehicle expenses, 7,200. Let's see, they came from the bank. So we paid out 7,240, and we've got our 7,240 in vehicle expenses in here. Update the accounts for this show and clear the balance we carried down. Select from your. So what have we got here? Got some more narrative. Let's see where we're going here. That's 3. Okay, so we've got. Oh right, and we also as well was some kind of accruals. Accrued expenses. And what happened here is that we had some brought forward balance brought down, and on the 1st of April we went debit that, and we went then credit the vehicle's expenses account. Okay, you now find out that there's an unpaid bill of £960 for vehicle fuel for the 2 months ended the 30th of April. So April, there's £960 worth of it. It relates for these 2 months here. So these 2 months here. Okay, so this was, we divide this by 2. This is outside the year, but this is our accrual. This is our missing set of invoices in here that's in the year, so we need to put that in. So we would have, that's a liability to us, so it's just 480, credit the accrued expense account, and debit the vehicle's expense account 480 here. And so we're now going to complete this vehicle's expenses one in here. Notice how we've been drawn into the idea of just doing one T account. Little bit silly to try and do that really. Let's always make sure that we've got a nice double entry going on here. So what we got as our options? We would have some form of bank of 7240. And then we're going to go for, we've got accrued expenses. And that is our 480. And then let's put in our balance carried down here. Which is going to be the net position there. Let's work out what our balance carried down figure is. So it's going to be, oh, well, it's not, sorry, it's not going to be balance carried down, sorry, transfer to the statement of profit and loss account. Let's put that in there to the profit statement. Okay, statement profit loss. Okay, now I'm going to drop that in. What is it going to be? With that plus that minus that. 74. 95. Okay. You now find that, so that's where we are. Complete the following statement, calculating the figure required, and selecting one option for each box. Adjusting for this will increase the effect on the total vehicle expenses. Oh, hang on a second. Right, so what we're actually sort of saying is that this is not in there, so we've now found it. So we're not included, and so it's not included in the account record. So this, sorry, this shouldn't be in. But let's leave it in for the moment. Here, because what we can see is actually we've gone from there to there, so we're going to increase it anyway. So let's just take these ones out, but we know that this is now an increase. Let's go back to here. It's just a little bit of a dull question really without actually putting the extra items in there. So what we've done is we've gone from this figure here to this figure here. So let's just insert our shapes there. So it's going to be an increase on the total vehicle expenses. And you see how having our T account just means that we don't really have to think about it. The adjustment is the total expenses figure transferred to the profit and loss. The adjustment is 480. The vehicle expense will show as a debit in the profit. Well, so it's going to be, yeah. So what we're going to hear then. So this is the to P&L. Okay, so we went credit the vehicle expenses account, and then there's the profit and loss account over here. Debit the profit and loss account. So that's our. So the vehicle expenses will show as a debit in the statement of profit and loss. There we go. Right. Why is it a debit though as well? Because it represents an expense. An expense is the reduced amount of profit available to shareholders, and therefore less of a liability to shareholders, and therefore a reduction in a liability, which would be a debit. Right. Anything else? No. That's task 3 done. Task 4. This task is about preparing a trial balance and reconciliation. So we've got some nice extended trial balance going on here probably. We're working on accounting records of the business for the year ended 31st of March. Right, so 5 extracts from the year ended accounts 31st of March. Let's put our timeline in. March, it will be 30x1, so we're crossing years. Oh, so it'll be x0. Nice. And let's drive through to, sorry, it won't be March, it'll be April. Right. All the way through to March there. X1. Right. Okay, we've got 5 extracts from the chart from the ledger account, so let's set up our T accounts again. Got our nice T accounts. What you should have as part of your things that you're taking with the exam, obviously, is a ruler and different coloured pencils and some highlighters as well. Right, okay, so what we got? We got bank. I do dislike the way that they put it to the left hand side. Balance brought forward at the 31st of March X1, so this is the end of the year. Okay, so 1410, so basically an overdraft. Disposals of fixed assets, and we've got a credit there. So a profit on disposal, was it? Yeah, profit and disposals, office expense. So we got a debit there for our expenses. This balance has been adjusted for accrued expenses. Let's see. Alright, okay. Let's have accrual. Let's use the terms that they're using. Accrued expenses then of 245. We've got purchase ledger control account, and that is a credit of 14,280. What else have we got? Rent receivable, and that's a credit income of 1520, and we're short of 1 T account. Let's get that going, because they're saying there's a prepaid income. Okay, we'll go for whatever they're going to go for. Prepaid, sorry, prepaid, that's terrible spelling. Prepaid income of 610. No, prepaid income would be a liability. The customer's paid income in advance, so it's hit our bank account and is therefore a credit, and so that will be 610. No accruals and expenses of or no accrual of payments of expenses or income other than those stated. Nothing else. Right. Okay. Let's flip over the page. Using all the information below, given the tables, enter the amounts in the appropriate balance, trial balance. So let's bring over our piece of paper that we would have written all this onto. Okay. Right. So our accrued expenses is sitting there as 245. And this is where you would have your highlighter pen, because you would just highlight them off as they've been done so you're not missing anything. Insert our bank here. We've got a bank 1410. So there you go and see, this is where having it laid out in the T accounts makes it much more solid, because you can see that was a credit there. Discounts allowed. Discounts allowed. So we have allowed, we've basically sold something and we have allowed a discount, so we've reduced our sale, so that is going to be a debit, 690. Disposal of non-current assets, so our profit on disposal is going to be our credit there, 180. Drawings. So our drawings is our payments to our shareholders, and so it's a reduction in liability to the shareholders, so that is 5260, because it's a reduction in liability to shareholders, that would be a debit. Okay, let's now go into our office expenses. We've got that one, 3865. Get that. Prepaid income, okay, which is going to be our liability of 610. Credit there. Get that off. Purchase ledger control account. Our liabilities to our suppliers, 14,280. Yep. And rent receivable credit of 1,520. 20. And clear that one. Oh, let's just check. And I'd already done that one there, because that was that one there. Right, so we've cleared our accounts, cleared those there. We've got vehicles as well as our last one, and that is going to be an asset, so it is a debit, 18,600. Okay, so that's our trial balance there. Shame really it hasn't put the figures in at the bottom there to give us a space to be able to do it. We could, if we wanted to, which is what we're going to do now, make sure that we just test this. So let's just insert some 2 columns there and just put these figures in our debits and credits, because what you're given here is an opportunity to just test whether you're right or not, because will it balance, and you're being just tested to see whether you'll actually do that. 690 and 180, yeah, 5260, 865. It's entirely possible that the rest of the question might have some form of suspense account, so we'll see what happens here. So at least we'll have a good idea about what's going to come up. And let's add that up. Okay, so it's different. So we have got a difference really on our. I'm now going to whack in suspense account. If there's, you're now ready to reconcile the purchase ledger control account to the purchase ledger, right? Oh, so we've got some suspense going on here. Right. So balance showing the purchase ledger control account is a credit of 14,280. Yeah. The balance is And the total amount of the purchase ledger is 14,350. Right, let's pull this out as a separate section here. What I'm going to do is I'm going to basically create another piece of paper. I'm going to copy this here. Actually, let me just pull the whole, push this to the right, put an extra piece of paper in here, and let's see what's going on. So what you want to do then is, we're doing a purchase ledger control account one there, is we're going to lay this out with two T accounts here. Purchase ledger control account and the purchase ledger. Purchase ledger control account is a credit of that there, and the purchase ledger is a credit of 14,350. Right. Purchase ledger has been compared with the purchase ledger control account, and the following differences are identified. Settlement cash discounts received of 180 has been entered in the purchase ledger accounts, but has been omitted from the purchase ledger control account. Okay, so 180 has been entered into here, but is missing from here. And this would be discounts received. So this would be a reduction in the amount there. So 180 would be journal number 1. So that's an error of omission. So what we would have here as well is we would have another journal, or another T account, which is going to be our expenses. Let's just see what happened here. It said it had been entered in the purchase ledger accounts, but is omitted from the purchase ledger control account. So actually it's just been omitted from the purchase ledger control account. Okay. A payment of 645 has been debited to the purchase ledger account of Amory instead of the purchase ledger account of Avery. That's just within the purchase ledger. So that's an error of commission. So that's not going to adjust our purchase ledger account. It's not going to adjust purchase ledger control account. It's just going to just move between two accounts within the purchase ledger. A BACS payment sent to a credit supplier for 450, but the amount should have been paid should have been so a BACS payment sent to a credit supplier was for 440. So we've sent them 450, but the amount should have been 540. Right. So what we did here was we went in our bank. We went credit bank 450. Debit purchase ledger control account 450, and then that would be what we would do before they got to this 14,800 there though. But that's just what's happened. It's not really an issue really. That's just we paid the wrong amount, but it's not a double entry bookkeeping problem. A set-off entry for £300 has been omitted from the purchase ledger control account. That isn't an issue. So we would have our another T account here. And here's our sales ledger control account. So we would have a debit balance in our sales ledger control account. We've set off 300 against it, and we've missed out here the debit against there. So we've set off omission as well. So that's where we're going there. So that would be that. This has already been in the sales ledger control account, which actually we don't really have in here. So perhaps it wasn't supposed to balance in any case. It's a little bit sloppy in terms of a question. Right. A purchase of 550 from Hewitt & Co. has been omitted from the purchase daybook, but has been correctly entered into the purchase ledger. Okay, so we purchased 500, it was omitted from the purchase daybook, so it never actually hit purchases, and it never hit the purchase ledger control account. Okay. That's not going to be responsible for any of the differences. Let's just hold that one at the moment and just note 5. Note 5. See what's happening there. A purchase return of 240 has been debited to the purchase ledger control account of Bristow Limited instead of the purchase ledger account of. That's just another error of commission. So that, and within the purchase ledger, so it's making no difference at all there. Right. Okay. So that's that. What we're supposed to actually do with this. Using the table of also 3 adjustments you need to make the purchase ledger control account. So let's have a look. And here. So these two definitely are the ones that need to be in here. So we've got 2 ones going on here. Right. So it was, let's go back to here, we had our number 1, which was the AAT, adjustment number 1, and the amount was 180, and it was a debit. Okay. I'm just going to put the number in there, in the debit line there. Okay, and number 2. Sorry, it wasn't number 2. Let's go see what the number was. The second one was this 300, so it was number 4. Here, and the amount for that one was 300, wasn't it? 300, yep, there, and that was also a debit. And let's go back now, so we're missing, because sometimes you can have ones that look like, then you just pick the best, you pick the one that's got the best scores. So we were looking at number 5, wasn't we? A purchase of 550 computing code has been omitted from the purchase daybook, but has been correctly entered into the purchase ledger. Oh, so it's in the purchase ledger, so it's in here. It was omitted from the purchase daybook in there though, so it should have gone into the purchase ledger control account, and it should have gone into expenses. So we should have gone debit the expense, and we should have gone credit the purchase ledger control account. So that's what should have happened there with number 5. So let's put that one in now. Number 5, and the amount of, what was it? Let's just go back and just check it. What was it? 550. Sorry, not 500. 550. 50. And let's just get that. And that was a credit amount. By 50. Okay, that's the answer for that. That seems to be the end of that question. It's a bit fast. Okay. Task 5. So this task is about accounting adjustments in the extended trial balance and closing off accounts. Okay, so we have some T accounts going on here. You're working on accounts records for the period in the 31st of March. So let's put a timeline in. 31st of March. Drag that out to March there. Okay, trial balance has been drawn up and a suspense account opened. Oh right, okay. Well, let's get our T accounts all ready, because one of them's going to have some heavy suspense accounts going on here. All good fun. Right, so we got our T accounts. Okay, right. So we've got our trial balance drawn up. Suspense accounts opened, right? So we've got a suspense account, and it's got a debit balance of 1060. Okay. You now need to make some corrections to adjustments up to the year end of 31st of March X1. Right. Record the adjustments needed and on the extract from the extended trial balance to deal with the items below. You will not need to enter adjustments on every line. Do not enter zeros in there. Right, so entries need to be made for an irrecoverable debt of £165. So, provision for doubtful debts. Debts and irrecoverable debt expense. We'll have something like that there though. So it's £165. Oh, hang on, so irrecoverable debts. So, alright, hang on a second. Sales ledger control account. So, doubtful debts would be a doubtful debt expense. Irrecoverable debts is, with this thing is definitely gone, so it'd be £165 going into our sales ledger control account. Actually, what we're going to do then here is we're going to set up some journals as well as we're going along. So we're going to have debit the irrecoverable expense, 165, and we're going to have credit the sales ledger control account, 165. Okay, a little bit tricky there. No, nice little tricky one there between that and a doubtful debt one. A payment of £700 for vehicle expenses have been made from the bank account. The correct entry was made from the bank account. The correct entry was made in the vehicle expenses account, but no other bank. So we've got a bank account. So we're going to have in here. Then it will be debit, let's do this credit first, credit the bank, so that's what we did because we missed that out, that's the error of omission, and we're going to debit our suspense 700, being, and let's see what this is, error of omission, isn't it? Error of omission. Right, no entries have been made for closing inventory for the year end 31st of March. So our closing stock. Right, okay. Closing inventory. Statement of financial position. Actually, what I'm going to do is I'm going to do P&L. P&L. I'm going to do closing inventory, balance sheet. So balance sheet is another word for the statement of financial position. Right, closing inventory has been valued at 4400. However, we're going to have some kind of thing in there. This item includes items costing 1,500, 1250. That actually will only be sold for 990, so we realise that loss of value straight away. So actually the closing inventory is going to be this figure here in our debit figure. Sorry, in the P&L it's not, it's going to be the other way around, sorry. 14400, 1250, which is the value of the items which actually have a value really of 990, and so the in the balance sheet is going to be that plus that minus that. Okay, so that's what our value is there. Okay, the figures from the columns in the purchase day book have all been totaled correctly. Okay, so we got purchases, but the amounts have been posted. Right, so we've got some errors posted here. We've gone purchases, credit VAT instead of debit VAT. So we've got the purchases correct, but the VAT should have been debit VAT, and instead we've gone credit VAT. So 880 there. Okay, and in fact it should have gone 880. So we're going to reverse that one out, and we're going to put the correct figure in. So we're going to go credit our suspense account, these two here. So credit suspense 1760, and we are debiting VAT 1760. Okay, that's what we've got so far. Let's take this over to the next page. Extract from the trial balance. Alright, let's go through then. So we've got our allowance for doubtful debts. Remember, it said it was an irrecoverable debt. So it wasn't in the allowance, it wasn't a provision for it, but we're not touching that. So let's start putting in there. We've got an irrecoverable debts position in our adjustments, which was debit 165. And then we're going to credit sales issue control account there. We've got a figure going into our suspense account. So let's put that in there as well. Make sure that we can. So we've got our suspense account here. Debit our suspense account 700. And that's 700 there, and now that's going to go into, where do we put that? It was bank, wasn't it? Bank was credit the bank 700, and then we're going to go debit the VAT 1760. And credit our suspense account 1760. Now, within these tests as well, you're always going to be able to then just check whether your suspense account now balances, and that tells us that our answer is right. And so we've just put that in, and that is the extracts from our trial balance. Now what we also as well got to do then is we've got the other one, which is, let's just make sure that we've cleared off all these things. We've got that one. This is where you get your highlighter pen out and just check that you've missed one of those ones off. So that's there with the, so that's that one, and we've got 2 VATs there with our suspense account there. And then we've got the last thing to clear. So we should have put our bank account actually in here as well, just to make sure that we were fully out. What was it? It was credit bank account, wasn't it? 700. So what we can see is here we go, and this is the advantage of having it out, laid out in paper. We now need to do the closing stock. We've calculated what they are. Statement of financial position. And the statement of financial position is going to be an asset. And the statement of financial position is another word for our balance sheet. 14140. And statement of profit and loss is the reduction in the expense. A reduction in the expense is an increase in the amount of liability to shareholders, and therefore that will be a credit. So there's our statement of profit and loss. Okay, and so that's that. Right, let's now move on. The ledger is ready to be closed off for the year. Fill in the account names and tick to show the entries to close off the office expenses account. So let's go over here. Not follow that one. We'll change this one to the office expenses. Let's see what we've got in here. Office expenses, we've got a debit balance of 18370 here. Right, so we will now go to close it off. What we do is we're going to credit that to the profit and loss account, whatever we're going to have. It might be a statement of profit and loss, it might be a profit and loss account, whatever it is, 18370. And the alternative one here, just copy something over here. It's going to be to the profit and loss account. It's going to be the opposite side of that one. Right, so let's now choose what we're going to have here. We have gone credit, and we're going to credit the office expenses one. Expenses account, and we would credit it with the 18370, and let's put that into the debit one there, and that one is going to be, what do we have here? We've got a statement of profit and loss account, which is what's used in this particular one here. Or have we? Let's just find it somewhere. What have we got? Statement of financial, but it's not going to be closing the venture statement of financial position. Not that one. Not depreciation charge. Statement of profit and loss, that's what they use. You'll have to always look for this. Osborne books seem to like statement of profit and loss. BPP seem to go for profit and loss account. And there could also be statement of financial performance as well. If we were in another one, let's say Kaplan. So you always make sure that you can use those on the same terms for exactly the same items there. And that is then task 5 done. Quite short, that. 6. This task is about the extended trial balance and showing your knowledge and good accounting practice. You have the following extended trial balance. Your adjustments have already been correctly entered, so we've had the period and adjustments and they've been put in there. Extend the figures into the statement of profit and loss or statement of financial position columns. So in terms of the profit and loss account, which might be there, or the statement of financial position, also balance sheet, which is what we could call it for that one there. Do not enter zeros. Complete the extended trial balance by entering figures here. What I'm going to do is I'm going to line this up here. I think it's already, yeah, so I'm going to line this up here. I'm going to, instead of putting all the fiddly little shapes in, I'm just going to write it out next to it and see that that will be what will be put in there. So I'm going to do one thing first, is I'm going to put a figure in here, and then I'm going to put statement of financial position, and I'm going to go statement oh, sorry, financial position there. Statement of financial performance. Well, I'm going to use P&L. Statement of profit and loss. Could be the statement of financial performance. And I'm going to go debit here, credit there, debit and credit. So I'm just going to copy out effectively to them. Now what I'm going to do here is I'll give you a method by which, let's do it in number method in here. So we'll actually convert into what it would look like in an electronic version, and I'll also as well put the debits and credits to the right as well. So what we're going to do first of all is we're going to create our trial balance, adding in these adjustments first. So in here we're going to have our debits as being positive, our credits being negative. So 15450, and we add in another 200 for our positive there though. Allowance for doubtful debts is a credit, minus 750, minus another 750, so we'll set that with a minus 1000. But also as well, we could have it if you wanted to lay it out like that. That one, like that. We'll have an allowance for doubtful debts adjustments, which is going to be a debit, so that's 250. Yeah. 250. Our bank, which is going to be 2 credits, so minus 5400, minus 350. And that. Our capital, which is going to be minus 20,000. So you can have either one of these ones in terms of you'd lay it out like this or like this anyway. But either way, we've got to add these together. So this is the easiest way to be effective. Now our inventory is going to be that 12150, and we have the same thing in there because one's going to go to the statement of financial performance, or the profit and loss account, which is going to be the credit figure, and the debit figure is going to be going to the statement of financial position or the balance sheet. That's because that's the asset at the end of the year, so that will be that. Our depreciation charge is 4,000 as a debit. There's no more adjustments to that. We've got office equipment cost 30,000 as a debit, and we've got our accumulated depreciation as our credit, 12,000 minus another 4,000 the adjustment in the year, so that would be our credit there. And our opening inventory is a debit, so our debit there. That. Our payroll expenses is equal to 25,450 as a debit, and we've got a credit coming in there, so minus 300. So our debit in total there. So you can see here is we have to minus that off that because it's a debit and a credit. We take whatever the larger figure is. Purchases 125,000. Purchases and control account is our liability to our suppliers. Sales is going to be minus 19513, and there's also another credit adjustment, making it quite easy actually to be fair in these ones, because typically having the debits and credits being the same ones, we only had one that was different. But it's trying to just drag you into, maybe trying to lure you into a false sense of security. There's our asset of our amounts that our customers owe us, and here our selling expenses 18,400. Our suspense account all goes down to 0, and the 18,400 expenses is there, and the VAT is our liability of 2050. Okay, sorry, it's not a it's a minus 2. There we go. Let's go back here, minus 2050, and so that would be our credit there. Okay, so you could lay it out like this, which would be the number method in an electronic approach. So if I add all this up here, it should go to 0. There we go. And if I add the other two up there, it would look like the balance sheet like that. Okay, so that's how we're starting off with our adjusted trial balance. Now we're going to drop these figures in, and instead of putting them in here, which would be quite fiddly, I'm just going to put them over here. So I'm going to go through each item. So an administration expense is about the financial performance in the year. It's an expense in the year. The allowance for doubtful debts is the end of year position. So it's the amount that we're reducing from our sales ledger control account. Let's give our debtors position. We don't know which debt it is that's going. That's not going to be recovered, but it's going to be one of them. If it was irrecoverable debts, so an irrecoverable debt thing, that would be an expense within the year. We'd already know about it. Allowance for doubtful debts adjustment is the adjustment within the year. That's going to be impact on the profit and loss account. In this instance, it's a debit, so it's an expense. The bank is the bank's position at the end of the year, and that's that credit there. The capital is the amount owing to the shareholder, the liability to the shareholders from their opening capital. Their closing inventory. So the closing inventory, the credit goes to the profit and loss account because that's a reduction in the expense. The easiest way for us is to do the debit first, which is the asset at the end of the year, and that goes into the balance sheet. The depreciation charge is a debit, and that's in the statement of financial performance for the year in the P&L. The office equipment at cost is the asset, so that's it's the asset of the office equipment, so that goes into the statement of financial position or the balance sheet. The accumulated depreciation on that as well is how it's there. So this is the combined value, that minus that. So the combined value is 14,000. The opening inventory. Now the opening inventory, so the closing inventory goes here into the statement of financial positions. That's where we closed it, and there's a reduction of the P&L account expense. The opening inventory goes into the statement of financial performance, the profit and loss account, as an expense here. So next year, this will then be credited off and go then into the profit and loss account, and a new closing inventory would go in. Payroll expenses is the statement of financial performance, so it's the profit and loss account, the expense in the year. Purchases is in the year as well. The purchase ledger control account is the liability to the suppliers at the end, so that's in the balance sheet, so that's a credit in the balance sheet. Sales is there in the statement of financial performance, the P&L. Sales ledger control account is in the statement of financial position or the balance sheet. There's the asset. Selling expenses goes into here. There's nothing in the suspense account. The VAT is the liability to HM Revenue and Customs at the end, so it goes into the balance sheet from there. And so that gets us to this point in here. Let's now take these figures out there. Second. And now what we do is we add up our profit and loss account. So we add all of this up in here. And we add that one up there. And we got a difference. And our difference is, in this instance, the profit for the year, which is 505. So what we've got here in terms of what we're going to put in, we're going to have none of those. Gross profit stroke loss for the year, that isn't here. Gross profit is the sales minus direct costs. So it's profit and loss for the year, and because we've got all these other expenses and whatever, so it's profit and loss for the year. So I'll insert that shape into there. So what would actually go into here would be profit stroke loss for the year. Okay, just that spelling there. Okay, and the amount, which is going to be 55. Okay, oh sorry, and then so we're going to debit this here, and then what we will do is, where's the button? Sorry, we're going to drag that down there. Goes into this one here, into that cell there. Okay, so it would go into here. So it's debit here and credit then into the balance sheet. So we've gone debit. So we've closed off all of these accounts effectively. Credit in here, debit in here, what have you. Now ultimately then we get to this position at the end in here, and then that's transferred into the balance sheet over there. And if we now drag that across, see how our balance sheet now balances as well. And that is that part. Okay, so that's 6A done. Yeah, now let's have a look at 6B. Which of the following is not a purpose for maintaining financial records? Okay, so and this is the bit about accounting knowledge. So what's the not purpose of maintaining financial records? Well, to comply with statutory requirements, well, there would be. That's the reason why we're maintaining financial records, a lot of it, in terms of producing financial statements and tax returns, etc. So that would be that's definitely not that one. To depreciate non-current assets as quickly as possible. Well, when you see as quickly as possible and that kind of thing, you're definitely being told that that's what the answer is. But let's keep going. It's this one in here. To obtain credit financing, well, we don't need records to be able to sort of provide a set of accounts to obtain credits and financing, so that's the answer there. And to measure the business performance, well, if you've got a statement of financial performance, and clearly you're measuring business performance, so the answer there is B. There we go. B is the answer. Right, okay, an allowance for doubtful debts account is kept. Let's see what the question is here. To set aside a sum of cash to compensate the business with doubtful debts become irrecoverable. Possible. I mean, I don't like the word compensate, but it's there. To record adjustments to the trial balance when it doesn't balance. No, that's a suspense account. To show a realistic figure of the trade receivables in the financial statements position. That's a much better plan there, though. That's a way better answer. And then until the end of the financial year, when the balance is credited to the sales agent control account. That's almost like the fish question there, though. So, yeah, I'll just sort of say, when I was training, we used to have some multiple choice questions as the opening part of exams, and it used to always go something reasonable the answer, which was C, and then used to have the last thing, which was just a total nonsense, which was basically you may as well just to put fish in it or something like that. Right. So then, what's the last one? Which of the following statements is true? Revenue expenditure is expenditure incurred on the running expenses of a business. It is that one. The cost of repairs of a non-current asset, so the cost of repairs of a fixed asset is included in the capital expenditure of that asset. No, it's not. It's included in the cumulative. It's included in the statement of financial performance of the year. The cost of delivery of a non-current asset is recorded as revenue expenditure. No, it's not. It's the cost of delivery of a non-current asset or of a fixed asset is recorded as the cost, and then is put into the expense because it's anything that's required to put it in situ. The cost of the annual service contract for fixed assets is recorded as capital expenditure. No, it's not. Again, that's statement of financial performance. So the answer there is A. Right. Is there anything else on this? No, that's it. Right. Well, we're done. That's the whole of this assessment done. We didn't have any ethics questions within there, which is a bit of a shame. But generally, we had a lot of extended trial balances there. The general standard sort of fixed assets, non-current assets question, and a bit of prepayments and accruals. So hopefully that was enjoyable. Thanks for listening. Bye.